Hey, MLS Listings subscribers. Welcome back to another MLS Listings podcast. I'm your host, Dave Scalora, and I'm here today with Tom and Michelle from MLSList. In our first podcast, we discussed our partner economist, Dr. Elliot Eisenberg's thoughts on the fourth quarter of 2022, and we received a lot of positive feedback regarding their review and his thoughts on the economy and its impact on real estate locally. So we're back once again to take a look at his thoughts on the first quarter of 2023. If you want to read the entire document, it can be found on MLSListings.com under the link called Media Center. So I'll be introducing a topic, reading that portion of Dr. Eisenberg's document, then the MLSList team will offer commentary on those points. For this podcast, we have identified three main talking points, which are going to touch on how inflation, federal policy, and recent bank failures are affecting the local real estate market. Michelle and Tom will then discuss how those economic changes tie into the current data that we have and any possible signs pointing to the possible timing of an economic recovery. Again, we encourage you to review the entire document. It can be found on MLSListings.com. Just click on that Media Center link. All right, so let's go ahead and jump on into our first topic here. How are current economic factors affecting the real estate market? The first quarter of 2023 started off strong with good job growth and declining inflation. But as growth slowed toward the end of the quarter, the preliminary forecast for Q1 2023 slipped into the 1 to 2% range. In the biggest economic news of the quarter, mid-March brought the failure of Silicon Valley Bank and several other U.S. banks, followed by the Credit Suisse collapse. These bank failures presented a new wrinkle in the Fed's ongoing battle with inflation, as they now must simultaneously address inflation by raising interest rates while bearing in mind the impacts of duration risk to the banking system. As the markets watched to see what the Fed would do, in late March, they raised the Fed funds rate by 25 basis points, but in a nod to current conditions, they removed the expected ongoing increases in the target rate in their normal presser and replaced it with the phrase, "some additional policy firming may be necessary," which is the strongest indication so far that this rate-raising cycle may be nearing the end. However, this should not be yet construed as a pivot, and based on Fed announcements, we are likely to be into 2024 before we see rate cuts. Importantly, the stresses on the banking system make it more probable that credit standards will tighten and bank financing will be harder to obtain. In fact, in the immediate aftermath of the SVB crisis, financial conditions and lending standards quickly tightened by as much as 150 basis points, but have loosened since. Fortunately, there are other sources of financing, such as capital markets and private funding. That said, if banks are more reluctant to lend, this will undoubtedly slow the economy. Overall, the economy remains hobbled by the overpowering fear of inflation, and with all the other factors at play, the odds of a mild recession are quite high. We are currently facing a significant number of headwinds. The tech and financial sectors have taken a beating over the last several months, the yield curve is inverted, and most leading economic indicators are at levels traditionally associated with recessions. The key strength of the economy right now is in the labor market, as job creation remains double-trend growth but is noticeably slowing.
Thanks, Dave. I think the interesting part and the reason we grabbed that particular portion that started off Dr. Eisenberg's first quarter look back is that there's a very specific component of lending and how lending or a tightening of lending would affect Silicon Valley and Silicon Valley adjacent realtors. So our agents would be out there advising clients on home loans and affordability, and that the recent bank failures could in fact make that a little bit more challenging. So we've seen rates actually go down a little bit. We don't know if they'll go back up or continue to go down. But if it's harder to access money, which Dr. Eisenberg was pointing out, that becomes a real challenging component to the home buying process. And so while we're seeing the pie shrink, in other words, we're not seeing as many transactions, we haven't at least through the first quarter of 2023, this is not necessarily helpful to that, because if you're going out and you're wanting to close on a home and you can't access the funding, that would be a real problem part of the transaction. So, but as we were talking before, Tom, it's not necessarily a bad time to buy a home. In fact, for several groups of people, it's a great time. And so if you see those interest rates declining and you have cash, so therefore you're not borrowing as much and you're not going to be as affected by restrictions on lending, then this is a great time, because the interest rate is going to affect you less than it would if you were buying a large sum. And so for people who have, done the hard work and stowed away money and, underspent and did all the hard things we know you're supposed to do, or at least you hear, growing up, and you have that and you could put down a higher down payment, then you won't be as impacted. The interesting part, I think, is that the Silicon Valley buyer profile has in the past been high wage earning people, so people, whether individuals or partnerships, where you earn a lot of money and can pay a high monthly payment, but haven't necessarily had that larger down payment. So we've heard, right, Tom, anecdotally through the years that that's a very common, put a very little down and then, increase what payment, have a higher payment. And that's going to be a problem in this particular environment.
Yeah, absolutely. I mean, just to put some real numbers to it, let's take a look at that $1 million loan, which, in our area is kind of a typical loan amount. It's not atypical, and it's a nice round number. And you mentioned that mortgage rates have gone down a little bit, but let's take a $1 million mortgage at 5.7%. And the payment on that mortgage, just principal and interest, 3-year fixed, right, is $5,833. Now, if we were to look at that same loan, same terms, but a 4.7%, so 1% less, the payment would be $5,212, or a $621 per month difference. So, I think at some point, it really does, hit people right in the pocketbook. Even those high wage earners, at some point have to balk, and when that interest rate goes up. So you're right. If you've got a lot of cash and you can put a lot of money down, then, and you're at a $500,000 loan, totally different story. But if you're in the situation that you were talking about, where you're a high wage earner, but you have to take out that $1 million plus loan, you're paying a lot more per month for it.
Absolutely. I mean, we've heard some really wise, seasoned brokers tell us that people are kind of coming to grips with the rates, right? And so understanding that, they missed the 2% and 3%. Elliot Eisenberg says he doesn't think that will happen again. I mean, but we never know, right? I mean, who knows? But he said not in the near future. And so the question to him was, is this still a great time to buy a home? And he was emphatically yes, because you can take advantage of lower prices in some places. We're seeing that change a little, Tom, as the Aculist people here in the MLS building, we keep our eye on those changes. But you can tell your buyers to lock in some of those lower prices, and so it's going to just maybe affect who's buying homes, right? So people with cash, we've already hit on that, and those looking to stay longer term. So this is one of those, if your clients are interested in staying in the longer term, then locking in a lower price or taking advantage of less competitive environment than it was a year ago could in the long term be very beneficial to them. And so people with job security, those feeling like they're not in jeopardy of losing their jobs, those who feel like they're going to stay here for a long term, and those who, like I said, have squirreled away some pretty significant cash would be in a good shape. I mean, the other, I think, interesting point about what Dr. Elliot said in his write-up is that one of the better sectors right now is emerging technologies such as AI, and we're hearing that all the time now, and we're talking a lot about it. And it's not so much that that's the sector, it's that it's hugely important. It's changing all of technology, and it's right here. Right. So if it were based in Austin, or if we had seen that move to North Carolina, along with some of the other technologies, it wouldn't necessarily benefit the Silicon Valley and adjacent counties. This is right here. And so those San Francisco buyers, those folks on the peninsula who are here and investing in that technology, part of those companies that will undoubtedly be pulling people on board, those could be really excellent buyers as well. So we'll talk about it here a little bit because it's part of our kind of recovery point that's coming up. But Dr. Eisenberg says, we'll recover faster than the rest. So there's all of these concerns about inflation that remain. There's concerns about bank failures that remains, the tightening of lending, and some other the debt ceiling. we have some economic, I think he called them headwinds, but he did say that because of some of those emergent technologies and the fact that they're based here, ultimately down the line would affect real estate in a positive manner.
Yeah, I mean, what I took out of his reading is, what makes us different. Silicon Valley has always been innovation and technology, and that hasn't changed, and that's not going to change. And the proof point are right, as you said, with OpenAI, with Google moving to Bard, their AI chatbot. So it's still happening here, and so the fundamental drivers of the region are still very much in place.
So it's for agents, who's buying, what profile best suits this economic client. There's always people buying, there's always people selling, Tom. But for the people on the fence or maybe considering getting into the market, these are just some points to consider. Who would be the better, where do you spend your time as an agent? Those are some of the profiles that we would think would be a better fit for this time period. So let's listen to Dave talk a little bit about nationwide and local interest rates, inventory prices, and then we'll come back.
Your clients and prospects are craving information on the most up-to-date real estate trends and the very latest market data. To satisfy their needs, share this month's Market Minute videos with them. One video for San Mateo, Santa Clara, Monterey, San Benito, and Santa Cruz counties each month. These videos are short, informative, and ideal for sharing with your clients and prospects. Find our Market Minute videos on the MLS Listings YouTube channel and share them today.
All right, let's go ahead and move on to our second topic. What do we see happening in the local market, and how do economic changes affect buyers and sellers? Nationwide February sales picked up mildly on a seasonally adjusted basis as buyers took advantage of slightly lower rates and more inventory to choose from. Now pending sales improved dramatically in February, which promises a stronger start to the spring selling season. While inventories have continued to rebuild, they remain at historically low levels, keeping something of a floor under prices. Builder confidence remains low but has improved slightly, and builders have generally been able to offer incentives as upgrades to move inventory rather than making dramatic price cuts, as was the case in the housing bust. Given the headwinds, including high interest rates, mortgage lock-in, low inventory, high prices, and a weakening economy, the national housing economy remains relatively strong. And after the frenetic pace of the past several years, what we are seeing is a return to normalcy. Without a doubt, the MLS Listings area and nearby San Francisco have suffered more than any other area of the country from the latest interest rate hikes. In addition to the direct impacts upon the housing market, the wider effects on tech and the knock-on effects on the banking sector have now created additional stresses on the MLS Listings housing market. While we have seen a strong recovery in tech stocks, much of that has been brought about by the right sizing that has led to layoffs within many firms. The failure of Silicon Valley Bank has done meaningful damage to the banking industry in general, but especially to the startup ecosystem. SVB was a major presence in the Silicon Valley, not only as a place for general banking, but also with lending practices that were especially suitable for startups.
That's really interesting what Dave was reading about from Q1 2023, Dr. Eisenberg's notes. I want to reiterate that you should go read the entire document because it's really great. He has excellent insights. We're pulling out 3 points, but this is the second one here. And I want to go back to something he didn't mention in this particular write-up, but he mentioned early on when we spoke with him early in the year, Tom, talking about how there are always buyers and sellers. There will always be transactions because people need to move, people need to buy a new home, families change, et cetera, et cetera. What he did say, though, was he was expecting that we might see a wait and see approach by those kind of on the fringe of the market, right? Don't have to sell, would like to sell, don't have to buy, but would like to buy. And therefore, we'd have this kind of like outside ring of people kind of watching to wait and see. And he used those specific words, and I've said it a lot out at broker meetings and with agents because it has really shown in the data. And how we know that is the transactions. We have not seen as many transactions. And so when you look at closed sales and you compare them year over year, or even to the last couple of years, you know that we have been trending much lower in the number of transactions. So that's, something that maybe will turn around this year. We're not sure, we have a while to go here, but what does it mean to our market? So what do you do about a wait and see? We talked today with some brokers that said, seeing prices change, buyers wanting to be on the upswing of things could encourage people to come into the market. It could encourage sellers when you start to see prices, which are still lower year over year. So not what they were last year, but increasing, at this time, could make them want to come on the market and say, hey, I am going to be comfortable with that potential sales and price. And so basically, though, Tom, the effect that it's having, the largest, most important effect is that with inventory low, not as many new listings coming on the market, it's putting upward pressure on prices. It's keeping it, steady, if not growing. In some places, it really depends on where you are. But Dr. Eisenberg says the bottom is holding and prices are staying relatively high. And the reason for that is inventory.
Yes, I remember him saying to keep an eye on inventory.
He said that. He said that when we met with him early in the year. He said that's going to be the biggest factor this year.
Yeah, and sure enough, right? Inventory levels have risen maybe a little bit, but not near. Or they're still way off of their norms, what we would consider their norms. And I guess I just want to make sure that we're reviewing what is inventory. So inventory is that stat that we take at the end of a period, whether that's inventory on the weekly reports, and hopefully everybody's looking at those weekly reports. It's a snapshot at the end of the week or at the end of the month of how many homes are available, which means they're active, they're contingent, but still taking backup offers, but they're available as homes. That's inventory. And we're still looking at, less than the 3 months of what would be considered normal, a lot less in some cases.
Absolutely. Dr. Eisenberg, I think in this document says, right, 1.4 to 2 months of inventory. And so, that just means that it's really limited. And so, when you go back prior years, Tom, you have to go back to 2019, 2018, 2017 to try to really understand the difference, because it has been tight for some time. And that's why we saw some of those really high prices last year, because it was extremely low. And so when he talks about inventory, and I'm so glad you took the time to explain what it is. I talk to a lot of agents and they say things like inventory, what's available. It's like, well, but it's a very specific snapshot, right? And so we also keep a really good eye on new listings, because new listings tells you what's coming in, right? And so that's why, especially on those weeklies, thank you for reminding people that there's the weeklies. But that's why we're also looking at pre-market, right? So we're trying to size the entire market and say, here's what's truly available, and here's why those prices. So if your clients are scratching their heads and saying, wait a minute, how did prices get back to, summertime levels, or what's the expectation? As long as inventory continues to be low, then there's going to be that pressure on prices. And so explaining to them, I think inventory is a really interesting stat, because it's not like a lot of inventory is good or bad, because there's been times in the housing market where inventory was very high and it was not a good market, i.e., 2010 and 11. And that's because of what kind of inventory we had. And so, people say bad, it's, low inventory is bad. It's like, well, if you're coming on the market, you're enthused to have less competition. If you're selling your home, it's an ideal situation, because then the competition is less. And if you are a buyer, you would love to have higher inventory, because it makes competition, therefore what you have to purchase price lower. And so I'd like to talk about inventory as a very neutral stat, but a very important stat, and the factors coming into it. Like I said, new listings. Is inventory sitting? Does that mean there's higher inventory because properties are not closing? Maybe there's a mismatch in the equilibrium of what people are willing to buy and what people are willing to take. So when Dr. Eisenberg talks in this section, it's a lot of pretty sobering news, layoffs and just rate hikes, and just talking about the bank failures, certainly all hitting close to home, not something we usually have, but I think he highlights it really well in this section. And so we wanted to pull that for you. We also, to note, would be looking forward, which is important, and we're going to focus on recovery here in a second, but looking forward, Dr. Eisenberg also mentions builders didn't want to find themselves with an abundance of inventory, scaled back nationally, right? Saying all over. And therefore, we're going to be in a low supply environment for some time because builders have scaled back. And therefore, as whenever recovery happens, as you see prices start to come up, when you see buyers really coming out, there's not going to be as much inventory or many new listings and properties to purchase. And that could also, Tom, we'll have to see, but it could also put upward pressure on prices.
Yeah, just a note on the builders. I was looking at the Builder Confidence Index, and the Builder Confidence Index that I could find on the internet only goes through December 2022. So we have to get updated numbers. But just this stat from December 2022, it blew my mind, which is the year-over-year change in builder confidence. It was down 63.1%. So in December of 2021, Builder Confidence Index was 84, and this past December, Builder Confidence Index was 31. Now, I think Dr. Eisenberg has said that that's changed, and it's back up a little bit from 31, and maybe he'll have a number for us when we see him. But really, really interesting stuff. And that builder confidence means that yes, the supply of new homes in the future, newly built homes in the future will be diminished.
So we'll have to wait and see, Tom, how that affects supply moving forward. I am glad you mentioned Dr. Eisenberg will be joining us for a live event on Thursday, May 18th at 1 p.m. So he will be coming back. Mark your calendars. And if you missed it, it will be on YouTube. And so we hustled to try to get that out. So I'm glad you mentioned that. And I also have to note, I come on the show and ramble, and Tom brings the facts, right? So thanks for that, Tom. That was a great stat. Hopefully some of our agents can share that with their clients as well. Let's listen to Dave talk about the nearby MLS area, San Francisco, tech sector, office policies and whatnot. And we'll talk about recovery here when we come back.
All right, so for our third and final topic, how will the Bay Area recover and what are the elements for recovery? San Francisco and the nearby MLSListings area have suffered from one of the worst housing markets in the country as interest rates rose. The tech layoffs, which are more about right-sizing after the post-pandemic hiring spree than any real weakness in the tech sector or the larger economy, have added to the natural slowdown in the real estate market as both prices and interest rates rose. The tech sector has been highly resistant to return to office policies, and as a result, many office campuses and buildings remain nearly vacant, which poses an ongoing concern for investors of commercial real estate. Moreover, where many tech workers were previously considering multiple job offers, now they may be more concerned about keeping the job that they have, and thus be unlikely to purchase a home. Interest rates remain high, and while the Fed typically starts to lower rates 3 or 4 months after raising the last time, there are a few signs that they will do so now and risk re-triggering inflationary pressures. This is likely to hamper the recovery of the tech sector and thus the MLSListings housing market. Existing homeowners are also likely locked in to existing low interest rate mortgages and thus unwilling to upgrade. These are myriad and challenging headwinds, and it may take longer to recover than we thought as recently as several months ago. Still, while there may be challenges ahead, tech firms are always in the lead of the pack and the area will recover. Just like after the dot-com bust, especially as new technologies like generative artificial intelligence move forward rapidly. Dr. Eisenberg says, although the odds of a recession are relatively high, just as this is not a copy of the housing bust of 2007-2008, it is also not a copy of the dot-com bust of 2000. The economy generally and the MLSListings area specifically will recover much faster this time.
So I think that the portion of Dr. Eisenberg's Q1 2023 write-up that Dave just read to us, it's some of that's pretty tough news, Tom. And in the whole, document, if you read it in its entirety, he just outlined some of the challenges of the current real estate market. He recognizes that, there could be more interest rate hikes. And if that is the case, it would slow the market further because the housing market is so tied to what happens there. He, made some really interesting points, but I think there's a bit of hopefulness to it because we know by the data that we're seeing and by anecdotal evidence that there is higher traffic at open houses. And there are very serious buyers there. We're hearing that, paying over list is back. And I even in a meeting earlier this week heard some offer deadline dates. And that was something we had not had for several months here. And so I do believe that this is a robust market, and there is still a lot of value in properties in the MLS kind of territory here. But two things that he mentions here, and he talks about work from home, and he talks about people going back to the office, and he talks about how that affects how people purchase. And so a couple of things he said, job security is going to be a big one, right? We touched on that earlier, but he does mention that job security means that people are less likely to enter the housing market if they're not confident, being that this is a huge purchase and transactionally very tough. So he does mention that. And so that's going to be a big factor moving forward. Whether interest rates are raised again is going to be a big factor. He mentions the performance of the stock market and how, people feeling wealth, the ability to pay. We still have high property values and taxes and things of that nature. So, he's talking about that. However, he also mentions, sellers who are locked in, right? And I think this is one of the bigger challenges we have in the market, which is if you have a low interest rate and you're comfortable in your home, are you really interested in moving right now? And, the typical, increase the house size, then the kids leave and you decrease, that whole cycle is really being disrupted by people who are saying, I'm not moving because I can't necessarily be in a better situation without a significantly higher cost. And so that locked in that he references, it's going to be part of that wait and see, and that will seriously affect what happens in the market going forward.
Yeah. As I mentioned, I think, towards the beginning, that $621 difference in that $1 million loan payment is gonna be prohibitive for some of those people that are sitting on sub 3% mortgages. So yeah, that's a huge factor. But you also mentioned the stock market, and so much of the wealth of the area is based on stock options and portfolio investment. And a lot of the companies in our area are in the NASDAQ. And so I was looking at year-to-date returns for the stock market and some interesting stuff. The NASDAQ year-to-date is up 16.72%. And compare that with the Dow Jones, which is only up 2.2% since the beginning of the year. Standard & Poor's, which I think Warren Buffett is his preferred index, is up 8.2%. So the NASDAQ is double Standard & Poor's returns year to date. So good news for the buyers out there that are depending on that stock portfolio to increase.
Yeah, I mean, that tells you it determines wealth, right? And wealth is a big word because it could come from a number of places, but certainly in the Valley, we see that a lot is dipping in or selling stocks, or even just counting on that wealth to get you into a home or to get into the dream home or wherever you are along the cycle, certainly. And I think too, I'm going to end here with a quote, right? So Dr. Eisenberg says, although the odds of a recession are relatively high, just as this is not a copy of the housing bust of 2007, 2008, it's also not a copy of the dot-com bust of 2000. So we just heard Dave read that. I did want to re-emphasize it because when he says the economy generally and the MLS listings area specifically will recover much faster this time, again, we can talk to our clients about the fact that, there's a lot of emerging technologies in the area. We are seeing some improvements, as you were mentioning, the NASDAQ, mostly technology-focused stocks and companies. So there are positive economic factors that lead into our area, our workforce, our communities. It's just really recognizing that there's 2 or 3 questionable decisions. It could go either way. It will affect home buying. It will affect who lists their home. So, we do this podcast to try to make Dr. Eisenberg's really thoughtful points a little bit more conversational. And so just to get a grasp of some of those things, I hope that folks listening have taken some of that information and can now convert that into conversations with people out and about, and surely talk to your clients. You don't have to be an economist to go out and just make a few points about some things we're looking at, some things to keep an eye on, and to not be surprised by how federal or economic changes impact the local market. So thanks a lot, Tom. I think this has been great. Stay tuned. Angela's going to read some of his points. So Dr. Eisenberg had some closing points on just the local market. She'll be reading those and wrapping up this podcast.
All right. Can't wait to visit with Dr. Eisenberg in a few weeks.
Do you have questions about an MLS listings product or service? Got feedback on how we can improve an existing product or suggestions for new services that would make your job easier? Then join us at our open forum online event, which happens on the last Tuesday of every month at 2 p.m. Members of the MLS listings team will be on hand live to answer your questions and hear your feedback or suggestions. Pre-registration is required, so watch your email or visit our pro site for the registration link to our next open forum.
Thanks again, Tom and Michelle. This is a podcast designed to provide you with talking points to share with your clients. And again, you can find the document in its entirety on MLSListings.com under the Media Center tab. If you found this podcast helpful, please let us know. We welcome your feedback. Email hello@aculist.com with suggestions. A quick important announcement, Dr. Elliot Eisenberg is going to be part of an MLS Listings live event on Tuesday, May 18th at 1 p.m. Keep your eyes on the Pro homepage for registration information as we get closer to that date. If you missed the event, the recording will be available on YouTube. But don't tune out just yet. Please stay tuned for summary points made by Dr. Eisenberg regarding the Bay Area real estate market.
Year over year, single-family home prices across the region declined during the first quarter of 2023. With the largest percentage decline in Santa Cruz County, where prices decreased 15.8% to a median home price of $1,200,000. The smallest percentage decline was in Monterey County, where prices dipped 4.3% to $846,000. Home prices remained the highest in San Mateo County, where the median price was $1,750,000. An 11.6% decline over quarter one in 2022. Prices in Santa Clara County declined 14.1% to $1,590,000, while prices in the San Benito County decreased 11% to $750,000, the lowest price in the region. The townhome and condo market saw smaller year-over-year median price declines than the single-family market, and common interest prices in San Mateo County actually increased, but by a very small 0.4% to $954,000. Prices in Santa Clara County declined 8.4% to $889,000, while prices in Santa Cruz County declined 2.9% to $830,000. Prices in Monterey County declined by 5.7% to $641,000, while prices in the San Benito County saw the largest year-over-year decline across the region, shrinking 12% to $470,000. Year-over-year closed sales for all types of properties declined by about 35%, and the combination of lower prices and declining sales pushed overall sales volume across the region down by 45%. Overall, new listings of both single-family and common interest properties were down 35% across the region compared to last year, with the largest percentage drops being in Santa Clara and Santa Cruz counties. While overall active inventories increased compared to last year, the gains were relatively modest and inventories remain at historically low levels. There is just a 1.4 month supply of single-family homes in Santa Clara County, a 1.7 month supply in San Mateo County, and a 2.7 month supply in both Santa Cruz and Monterey County, but a 3 month supply in San Benito County. The percentage of list price received at sale compared to last year declined precipitously across the region, but remains relatively strong. Single-family homes still sell for 101% of the original listing price in San Mateo and Santa Clara counties, while they sell for 99% of their original listing price in Santa Cruz County and 98% of their original listing price in Monterey and San Benito counties.